at Merrill Lynch for many years and is now with a Canadian firm, Gluskin Sheff. And he's making the point that both the yield on the 2-year Treasury note and the S&P 500 can't both be right, considering where they are right now. You'll notice, and this only goes back a little more than a decade, the lines tend to parallel one another. You've got a divergence here where stocks ran up and bond yields started to come down, and that was the peak in 2007. So that one, at least, the divergence did say caution was worth taking. And then we started to parallel again on this route, and then now we've started to digress again as stocks have rallied and bond yields have gone lower. Now, you can't say that because we've got a divergence here that we've necessarily going to have a response like occurred here, but it's at least a red flag. It goes up and says, right now, they're not confirming one another, which at least adds at least a note of caution. Stocks are apparently anticipating a revival of economic growth and or a flood of new money coming in from the QE2 approach. Bonds, on the other hand, appear to be anticipating no real resurgence of business growth or a disinflationary or deflationary tendency prevailing. It's not a balanced condition, so one or the other will have to change over sometime before too long. If stocks continue to rise, it's likely that interest rates will also rise, which would be bad for bond and bad for bond prices, rather. But if bond yields stay low, it's either a case of deflation or disinflationary forces setting in, which probably would be a negative for the stock side. So one of the two is likely to prevail, and we don't know which one that will be at this point. One more point on volatility. I show you here on this last page, this is the day of the flash crash. This is May 6th. And I just show it because it makes the point that right now there are factors other than economic factors and normal market valuation and sentiment factors. There is something going on in here which hasn't existed in the past, and that is high frequency trading. High frequency trading may not have been the sole cause of this dramatic drop. It was 1,000 points in the day down to the bottom, and about 650 of that were ultimately recovered. But this is a minute-to-minute graph, and in about 8 minutes it dropped, I think, about 700 points. And then in about 10 minutes or so, it recovered most of those on May 6th. And they've done a study on it, and they point to a mutual fund placing a $4.1 billion order through an algorithmic trading approach that didn't quite do what they hoped it would do. And then you had the high-frequency trading computers kicking in and accentuating the problems. Interestingly enough, high-frequency trading has now gotten on the public's attention span, or in the public's attention span. Some of you may have seen the program on 60 Minutes on Sunday night, where they were talking about high-frequency trading. And one of the things that was most interesting to me was that they were interviewing one of the fellows who runs one of these algorithm writing firms, and he boasted that he was the only guy in the firm that knew anything about the stock market. All the other guys were quants and just high-tech gurus that could write these beautiful algorithms. But you're dealing now in the markets, especially as volume has contracted, but for high-frequency trading, you're dealing with people who are not just trading because of valuations or anything else having to do with traditional stock analysis. They're playing for pennies, and they throw in more than 50% of the volume. I've heard statistics up to 70% of every day's volume coming from high-frequency trading. It's a very different world out there, and it adds to the level of risk exposure for people who are legitimate investors. By way of conclusion, let me summarize a few points. First, don't get wrapped up in beating various market averages on a short-term basis, be it a quarter, be it a year. Lots of one-year gains and losses turn out to be noise when we see the long-term patterns evolve. You see that when you look at the long-term graphs. These things tend to move in long cycles. Second, recognize the extreme levels of risk in the economy with excessive debt and derivatives, very weak city and state budgets, which we didn't talk about tonight, and now the potential for competitive devaluations, which are becoming an ever-present and ever more threatening force. On the equity side, earnings are still growing for companies, and the Fed could flood the economy with so much money that it will find its way into stocks, as it appears it is starting to do. More and more of this rally, I suspect, is due to the anticipation that we're going to have that flood of Fed money. But, as we showed, valuations are very high, the economy is precarious, and sentiment is extremely optimistic. And we remain, going back to the very beginning of the talk on stocks, we remain in a long, weak cycle. Bonds have been the best area and could continue to do well, especially treasuries, if the economy stays slow or gets slower, if the Fed continues to buy bonds, which they say they're going to do, or if disinflationary or deflationary forces prevail. But yields are now near all-time lows, and flooding the markets with money could start serious inflation, though no signs other than in some of the commodity markets are really showing now. And that, if inflation should pick up, could hurt bond prices very severely. Worst case would be if our creditors, foreign creditors I'm particularly referring to, should fear the destruction of the dollar and run from our bonds. Investors could also end up being too conservative. Cash equivalents, even at extremely low yields such as they are providing right now, are still the best protection against falling stock or bond prices. But if the Fed actions pick up inflation or destroy the dollar, cash will lose value. Gold will probably rise over the next several years. That's the logical conclusion when you see central banks around the world intent on devaluing their currencies. But it's seriously overbought on a technical basis. And if a short-term economic or monetary crisis is avoided, and many people have bought gold because of the potential for monetary crises particularly, gold could come down in a very severe, painful correction, even if it's fated to go higher in time to come. There's no clear right answer right now, especially in the short run. We are heavily in cash equivalents, as our clients know, but we're looking for opportunities in stocks, bonds, gold, or foreign currencies on a strategic basis, as we've done intermittently since 2003. And in a highly dangerous environment, I would caution you strongly not to tie yourself into long-term positions. Stay flexible. Any long-term position could prove very wrong, very costly. Above all, treasure flexibility and liquidity.